Hey everyone, happy Friday. Thanks for stopping by the keynote at 2 p.m. post-lunch. Love the energy in the room. I've been with the dYdX family for the last 4 years. I'm currently the VP of Strategy and Operations at the dYdX Foundation. The dYdX Foundation is an independent nonprofit headquartered in Zug, Switzerland. We're focused on developing and growing the dYdX ecosystem. For those of you who aren't familiar with dYdX, dYdX is the largest perpetual DEX out there, but I'll get into kind of the nitty-gritty over the next 45 minutes or so. So the title of my keynote is The Future of DeFi Derivatives, a Path to $1 Trillion in Average Daily Volume. So I'm going to provide an overview of the derivatives market, discuss perpetual products, make the case for decentralization, discuss some technical challenges and solutions for DEXs, and then really give you a deep dive into the dYdX chain and some really cool stuff that we've been working on. So maybe just to level set and give everyone some context on the size of kind of the crypto derivative market, taking a 10,000-foot view. Last year in 2023, crypto recorded $36 trillion in trading volume, 80% of which came from perpetual trading. So, the perpetual product is extremely popular. It dominates the market. This is pretty similar to traditional finance, where derivatives trading is orders of magnitude much larger than spot. And I think Jake had a great presentation not too long ago, really showing the growth in Q4 2023. I think the last 3 months the markets have been wild. This week hitting kind of all-time highs, and so a lot of the trends that you see in Q4 have persisted and grown into 2024 as well. So if you look at kind of the breakdown of DEXs versus SEXs, you'll notice that historically centralized exchanges have just dominated trading volume, both in spot and in perpetuals. Though I think it's pretty interesting to see that spot DEXs have had higher penetrations with low kind of double-digit market share. That's kind of the red line in this chart here. While perpetual DEXs have really only been able to capture about 2% market share of the perpetual market overall. And so, one question I have is, and what we're here to talk about today is really what do we need to, how do we grow the market to reach $1 trillion in average daily volume? So, with centralized exchanges having about $80 billion in daily volume, decentralized exchanges for perps doing about $2 billion a day, there's really kind of two paths to grow the market. The first is growing the overall perpetual market, again, doing about $80 billion a day to get to $1 trillion. That's 10xing kind of their current volume. How do we do that? Bring in more perp traders, adding new perp markets. Pretty simple. The harder challenge here is how do we really grow the DeFi DEX market for perpetuals, and how do we grow market share for DEXs relative to SEXs? And that's really by growing the market, 50x to 100x. So achievable, at least by crypto standards, but we're really far off kind of the mark from where we are today. And so, in my opinion, and what the rest of kind of the keynote is about is really talking about how to improve the underlying infrastructure for perpetual DEXs, reaching kind of feature parity for DEXs relative to centralized exchanges, improving the user experience and onboarding for users, and then lastly, really leaning into new features that are uniquely enabled by decentralization and by decentralized exchanges. So I'll go into each of these in kind of greater depth. I think there was a panel earlier talking a little bit about kind of the popularity of perpetuals. I do think it's worth just level setting on why perps are so popular and are the dominant product in crypto, accounting for 80+%. I think historically, perpetuals have really become kind of the dominant venue for price discovery. Certainly that's been the case for Bitcoin and Ethereum the last few years. Maybe that changes post kind of all the ETF announcements, but that's been kind of a big driver for growth. But notably relative to other types of derivative contracts, options, dated futures. Perpetuals really are a more flexible type of derivative contract where there's no expiration, and they allow traders to go long or short, take kind of a more up or down kind of view on a given market without a lot of the complexity around having to pick strike prices or rollover collateral for a dated future. So historically, there's been a lot of adoption both from retail and from institutions. And notably, it's a more capital efficient product than just spot. You can take leverage, and there's really high liquidity. And so that's driven a lot of demand, as a lot of people have been just biased long on the market as a whole. We get a lot of questions on what is the use case of perpetuals. Obviously speculation is a big one throughout the industry, but also perpetuals do allow sophisticated traders to hedge. And also provide interesting arbitrage opportunities through delta neutral or cross-border or funding arb opportunities that are pretty prevalent in the space. So again, I talked a little bit about the market landscape. Today the market is definitely dominated by centralized exchanges with Binance, OKX, and Bybit dominating the market. It's been really interesting to see in the last year, especially after kind of the FTX news and some of the cases around Binance. Binance's market share has declined, but it's still very dominant. And some of that flow has gone to DeFi indexes, but ultimately, most of FTX and Binance's losses have gone to drive OKX and Bybit's growth. You can kind of see that in this chart. But generally, the messaging here is, for centralized exchanges, whether you look at volume or you look at open interest, it's a pretty mature market, honestly. There's a few dominant players that dominate the market. It's highly concentrated amongst kind of the three largest players. And so, a big question I think about is why do people still use, centralized exchanges? And we have to really understand, who we're competing with. And ultimately, as a centralized player, they have generally good UX, UI. They provide, fiat to crypto onboarding. You can get up to, in some cases, up to 100x leverage, 400 trading pairs, and it's overall a good user experience. But I think many of us in this room really believe that, decentralized exchange players are good on-ramps from fiat into crypto, but pretty far from this decentralization ethos that a lot of us are trying to build towards. And so, especially after the FTX collapse, I think it's centralized exchanges also have just a lot of drawbacks, and the general statement of not your keys, not your crypto. You'd think that more volume will flow to DEXs where you as a user can retain custody of your funds at all time. So then if you look at DEX perpetual market share, this is a chart that shows the breakdown of market share over the course of 2023. In the purple is dYdX, in the blue, or this bottom chart here. And you'll see that in Q4, there was also a significant growth in DEX volumes for perpetuals and outpacing centralized exchange perpetual volume growth. You also notice that while dYdX has dominated for the last few years, in Q4 you actually saw a lot of new perpetual exchanges come into the market and eat up some of that market share. And I'll get into some of the nuances there in subsequent slides. Lastly, I think it's worth mentioning, again, dYdX has been kind of the dominant DEX for DeFi perpetuals for the last 2.5 years. And I think this increase in competition really just shows that this is a massive market. If you assume that over time DEX perpetual market share will start to eat up centralized exchange market share, that the market penetration rate will increase. I think a lot of players are looking at kind of dYdX and the DEX perpetual landscape and see a really big opportunity to build better products and help drive growth for the industry at large. Okay, so then now that we've looked a little bit at the market overall, I think it's worth talking a little bit about the biggest barriers, in my opinion, for historical DEX perpetual growth, and really that's been at the infrastructure level. So, you as all of us as users, we really only see what's on the front end. Most people look at kind of the landscape. They consider things like trading fees. They look at the UX, UI. Hopefully it's non-custodial. And that's really the tip of the iceberg. The reality is, over the last few years, a lot of these DEXs have been competing really beneath the surface on a lot of different technical designs and infrastructure designs. And so whether it's things like index, different collateral types, different kind of liquidation engines, all of these are kind of very technical design spaces that have led to a lot of different models and innovations. And so, I think if you look at the overall landscape today, you just see a lot of different infrastructure designs. And, I think the one that most people are familiar with are just AMMs versus order books. And that, at a high level, I think that's an accurate delineation of the market. But then even within that delineation, there's just multiple iterations across 10 different dimensions that people are kind of innovating on the technical design of. And so I won't get into all of the details of which one's better, which one's worse. I'll let you kind of read the white papers and come up with your own assessment. But my general view is it's been really an interesting kind of few years of experimentation. And the biggest limiting factor here has been at the infrastructure level and the technical level. And I think there's been some really awesome breakthroughs in designs and interesting kind of innovations, particularly at the infrastructure level, that really allow for a massive catalyst and change and inflection point more recently. And so I think the easiest way to kind of describe this is by looking at the amount of volumes for DeFi perpetuals on different L1s and different L2s. I think Jake also spoke about this in his kind of presentation, but historically, if you think of like the optimal DeFi perp DEX, like the optimal design is really to have on-chain order books for any assets. I think that's been kind of the holy grail for many, many years now, but it's been really limited at a technical level based on throughput. And so historically, most DeFi perps have been on Ethereum as an L1. I think over the course of 2022, you saw a lot of players start to innovate on different L2s. dYdX moving to Starkware and doing over $1 trillion in volume was a massive contributor to that. But then you've seen, the rise of Arbitrum in particular, and other L2s and L1s really viewing perpetual trading as a key driver of activity in crypto. And so, one question you may have is like, what is really driving this push away from Ethereum mainnet to other L1s, other L2s? And so, at the core of DeFi perp trading is really this question of scalability. At dYdX, we're focused on really the high frequency trading use case. And so when you think of perp trading versus spot trading, the amount of scalability that a high frequency trader needs is really high. If you look at kind of our exchange, for every 10 transactions or fills on the exchange, there's probably close to 2,000 orders on the order book. Because people are placing orders really, really quickly. And so you need a system that allows for really high scalability, both at kind of the fill level and also at the order level. Ethereum as an L1 can really only support about 10 transactions per second. Some L2s can get you to maybe 100 transactions per second. But that's not nearly as close to the level of scalability that you need to really be able to compete with a centralized exchange. And so right here in the yellow, you can see kind of the dYdX chain starting to launch and then gain some market share. And that's really the focus of kind of the rest of the presentation, and why I believe that app chains really represent this inflection point for DeFi perps more broadly. So historically dYdX was an application on Ethereum using kind of Starkware as an L2. There was an off-chain order book and matching engine, and then using Ethereum as a settlement network that allowed for non-custodial trading to scale. But it really leveraged kind of the limitations of, the benefits and the limitations of Ethereum, where you're just competing for block space with everyone else. And so, over the last 2 years or so, dYdX has been building the next version of the protocol, dYdX chain, which is a Cosmos-based proof-of-stake blockchain, really building a layer 1 that has been designed and customized for the high-frequency trading use case for perpetuals trading. So, unlike kind of other designs, what's really unique here is that the validators that secure the proof-of-stake blockchain are actually running a version of the order book and matching engine in memory, and then gossiping transactions to other validators in the network with settlement on the chain. And so that allows for an insane amount of throughput and low latency, and really a user experience that it has been designed for this pro trader use case in mind. In testing, we got to about 2,000 transactions per second, so really increasing kind of the amount of trading volume that can be traded, orders of magnitude larger than any L2 or L1 in production. I think a lot of people have heard of kind of this app chain thesis and vertical integrations. Historically, people look at dYdX chain as really a case study of an application on Ethereum moving to an app chain. There's been a lot of challenges, as you can imagine, with bootstrapping the security and really building an ecosystem around an app chain. But 3 months in, it's been a very successful kind of transition, and I'll get into the weeds of that shortly. So yeah, I think to me the future of DeFi derivatives is really app chain driven. How do we grow 100x from here? There's really 4 kind of key components to this. One is scalable infrastructure. I think the app chain and dYdX chain is really forging the path here. We've been building kind of infrastructure for the last 2 years to provide highly scalable infrastructure, and now we're hitting that inflection point to grow from there. The second is improving the user experience. Again, I think the practical element is DEXs are not going to win against centralized exchanges by exclusively being decentralized. We need to reach kind of product parity, and then lean into things that are uniquely enabled by DeFi. And so really improving kind of the onboarding experience and focusing on building a product that people love, so that people don't even know they're using DeFi or DEX is really the objective here. The third is user control and community governance. Again, centralized exchanges are great, but they're pretty black boxy. There's been a lot of cases of not your keys, not your crypto. You're not really sure what the liquidations engines work. There's been kind of fat finger mistakes. There's something to be said about having a protocol that is fully open source, where all of the code is public, audited, and really where the ultimate users of the protocol can actually control all aspects of the protocol. And so that's something that is unique and differentiated relative to the landscape today. And then lastly, it's really focusing on new markets, and this is an area that dYdX is really focused on, and I'm excited to share some cool updates there. Okay, so just show of hands, how many of you have heard of dYdX? Okay, awesome. How many of you have actually used dYdX before?
Before the US blockage?
Sure. How many of you have used kind of dYdX v3, so on Ethereum? Show of hands. And how many of you have actually used dYdX chain before? Yeah, very few of you. Interesting. I guess we are in the US after all. Okay, so yeah, I'm going to spend the next kind of 20 minutes talking about the dYdX story and some of the cool things that are uniquely enabled on the dYdX chain. So for those of you who don't know, dYdX has been around since 2017, founded by Antonio Giuliano, who is an early engineer at Coinbase. The product suite has definitely kind of evolved over the last 5 years or so, but it's always been at the forefront of non-custodial trading and really advanced trading. So dYdX pioneered flash loans, DEX aggregators, margin trading on layer 1, and really the first few years was really focused on building to find product market fit. Antonio doesn't describe himself as an ecosystem or Ethereum maxi. Like, if anything, he's just a product maximalist and wants to build the best product for traders. Really, there was a big kind of breakthrough in 2021 with the launch of the smart contract on Ethereum and Starkware as an L2, and the launch of dYdX v3. That provided for non-custodial trading, so users really had control of their assets at all time with kind of all of the code open source. The downside of that was that there was a centralized order book and matching engine, and again, a centralized sequencer, but it proved that you could build a product that scales using non-custodial kind of technology. And so dYdX v3 was wildly successful. In 2.5 years, we saw over $1 trillion in volume, and the launch of kind of a lot of different product features. And then, as I mentioned, dYdX Trading, which is the core development team behind dYdX, spent 2 years really thinking through how can we decentralize more parts of the stack. So, any system is only as decentralized as the least decentralized component. How do we get the order book and matching engine and the centralized sequencer and the front end to be as censorship resistant as possible? And so the first step along that journey was really the launch of the dYdX Foundation, the launch of the dYdX token, giving tokens to users of the protocol, having the community allocate funds from the community treasury to fund various sub-DAOs like the Grant sub-DAO or the Operations sub-DAO, and then ultimately culminating with the launch of the dYdX chain, which launched in November of last year, where the community of token holders decided to adopt the dYdX token as really the main staking token for the proof of stake blockchain, and really leveraging open source technology to deploy a whole ecosystem around derivatives trading. So we get a lot of questions on why Cosmos. I think the development team looked at a lot of different L2s, a lot of different L1s when thinking through a design space, and ultimately felt that Cosmos was the most customizable and really the best kind of infra stack to be able to build a chain that was really focused on this high frequency, low latency, low fee trading experience for traders, and really allowing for the complete decentralization from the front end to the back end to the consensus engine. So what is dYdX chain today? Again, it's a fully decentralized perpetuals protocol. The order book and matching engine is not on-chain. It is off-chain and run by validators that are participating in consensus in the network. Having said that, running a validator is fully permissionless. Anyone can join and run a node. And the top 60 validators by stake weight participate in consensus. All fees generated by the protocol are passed on to validators and to stakers who contribute to the security of the network. And really leveraging the Cosmos SDK and the Comet BFT consensus mechanism to create a resilient ecosystem around derivatives trading. So the chain launched officially in November, and it's been a pretty wild kind of 3 months. The chain has already seen over $50 billion in cumulative volume. This week we hit a lot of different milestones. We had 2 days with more than $2 billion in daily volume. There's already been, close to $9 million USDC in fees that have been generated by the protocol, passed on to 15,000 stakers in the ecosystem. The chain launched with 33 or so markets, and in the last 2 weeks, we've seen 15 or so governance votes to add 50 new trading pairs, and really a whole community kind of evolve around the ecosystem. Just earlier today, I think we hit $100 million USDC in TVL, and over 140 million in open interest. So, and then about 72% of the dYdX token supply has already bridged from Ethereum to the dYdX chain, and about 100 million of that is currently staked to validators. So, from my perspective, the launch has been pretty awesome, and definitely has gone a lot smoother than I think we expected. As everyone can imagine, trying to migrate users' liquidity volume from Ethereum to an app chain, there's not a ton of successful case studies of that. And, I think we've shown that app chains can work and can work really well. And we're really excited to see the excitement and enthusiasm and adoption. And, frankly, this is really just the beginning. With the infrastructure being in place now, we can really focus on growing and scaling the app layer on top of that. So, how do we grow the app layer? There's really 3 core components of this from a product standpoint, based on dYdX Trading's product roadmap, and I'll get into each of these individually. The first is really around permissionless markets and getting a bunch of new markets added to the protocol. The second is increasing and improving the user experience, and upgrading kind of the onboarding experience. And then the last is improving kind of the core trading experience more broadly. Kicking off with kind of new market listings, one thing that centralized exchanges do really well is add markets for the hot new tokens that people want to trade. Historically, DEXs have been really slow to add new markets because it has to go through governance. And dYdX is no different. But I think that's really what makes DEXs unique is that the community really controls what markets can be listed. And so, one big thing that I think about is how can you increase the number of markets that are available on the exchange, and 2, how do you really increase the pace that new markets are added? And just recently, dYdX launched this new markets widgets tool on the front end, which really allows any user of the product to add a new market via governance in really a streamlined manner. And since this tool launched about 3 weeks ago, again, we've seen 50 new markets being added to the protocol about for a week, which is really great. And we expect the number of markets on the exchange to really continue to increase going forward. But this is really just the beginning. Right now, the markets that are available on the exchange are limited to your top 100 coins by market cap. There's a lot of new markets that come up. Right now, the exchange is really like cross margin. So adding kind of the long tail of risky assets can be pretty risky from a solvency or risk management standpoint. So a big focus of research and area of active development is how to enable isolated margin over the next few weeks, and really increasing the number of oracle sources to be able to support a lot of new markets. I think we do expect some really exciting updates in the not too distant future to basically allow really a isolated margin, and then a very long tail of riskier markets to be added to the exchange. But that's really kind of a short to medium term goal. Really, the long-term vision is to get to fully permissionless markets where really any asset with a price feed can be added to the exchange. Like imagine a world where you can really create a perpetual on any market. I think looking at Uniswap, a big driver of their success was that anyone could list a pool for any token, and really letting kind of the market decide at a permissionless level what people want to trade. I think our goal is really to allow people to create perpetuals for virtually any asset that they want to. And so over the course of this year, that's kind of a major project that a lot of people are focused on. One more piece of alpha for the room. I think one part of the problem here is like, okay, how do you add new markets? I think I've talked about that. The second big issue is, how do you get liquidity for those markets? And, one active area of research is really focusing on vaults and allowing vaults for this longer tail of markets to bootstrap liquidity and really incentivize market makers to then come in and start quoting in the books. And so I think you'll see some pretty exciting announcements there. But really, the big thing to walk away from this presentation is, today there's maybe 50 markets on dYdX. I think we have a stretch goal to hit 500 markets before the end of the year, and target orders of magnitude many more markets beyond that. So really excited to share that vision, and really only uniquely enabled by the infrastructure that's been built over the last 2 years. The second kind of key differentiator is improving the UX and really focusing here on partnerships and reducing kind of the barrier and differences between dYdX and centralized exchanges. And so over the course of the last few months, there's been a number of partnership announcements worth noting. So, one-click onboarding via Axelar and Squid, Noble, USDC, and native risk-free kind of issuance of USDC and Cosmos. There's been, an integration with Kado for direct fiat on-ramps, direct deposits and withdrawals with centralized exchanges for USDC on Coinbase, and with more other exchanges coming soon. And then the launch of the dYdX iOS app, and soon the Android app coming very soon. Lastly, I talked a little bit about kind of the exchange being user and community controlled. Again, the dYdX chain code is fully open source. It's been audited. It is deployed by independent organizations and validators all around the world. Anyone can be a validator. Anyone can deploy your front end. Anyone can deploy an indexer. All fees generated by the protocol go to the contributors who are securing the network, and the exchange remains fully non-custodial. I talked a little bit about kind of different players within the ecosystem, but I think it's worth noting that at the core of it is the dYdX community, and we have very active governance discussions and forums where various people talk about changes to the exchange. There's 4 different kind of entities and sub-DAOs that exist today. The operations sub-DAO, the dYdX grants sub-DAO that has distributed over $5 million to hundreds plus teams building around the ecosystem. There's the dYdX Foundation, and then there's the dYdX trading team, which is the core development team. I've been surprised to hear or to read kind of the news about Uniswap. I'm sure many of you saw that on Twitter last week about kind of their fee governance proposal. I think a lot of people still don't really realize that, on the dYdX chain, 100% of protocol fees accrue to validators and stakers, and all of those fees are in USDC. Unlike many other chains that have weird misalignments between different stakeholders, here, there's really a strong incentive to secure the network, and this just creates like a really vibrant and sustainable ecosystem around the dYdX chain. So again, this is kind of 3 months after launch, some metrics to consider. There's no token inflation, there's no block rewards. It's really driven by all the demand for the exchange and protocol fees that go to people securing the network and participating in consensus. So what does the ecosystem look like today? There's hundreds, if not thousands, of independent contributors to the ecosystem. That includes market makers, infra providers, validators, researchers, custodians, tooling and analytics providers, press and media. Really, the focus here is to convince you that dYdX is in the hands of users and a bunch of independent organizations who are independently contributing to build on top and around the ecosystem, and being a fully open source blockchain, we're really excited to partner with people all over the world who are excited about what we're building. Just to wrap up, a few takeaways. dYdX chain is 3 months in, already the largest DEX, but we're not stopping there. The goal is to become the largest exchange period, and we think the way that we do that is really by leaning into being decentralized, being fully open source, getting to product and feature parity with centralized exchanges, but then really continuing to drive innovation for the chain and the ecosystem going forward. Again, the last 2 years have been very focused on building this infrastructure layer without really any product improvements at the app layer. And now that the infrastructure is in place and it's highly scalable, I think over the next 12 to 24 months, you'll start to see a lot more adoption and market share growth from DEXs to centralized exchanges. If you're excited about what we're building, we'd love for you to join us. We're really looking for all types of contributors, whether that's traders, market makers, developers, governance participants, really anyone interested in building or integrating across the chain, either at the infra level or at the app level. There's a lot of different opportunities to get involved, so feel free to grab me after the keynote, and I'm happy to point you in the right direction. You can follow us on Twitter, you can go on our forums, and you can scan this QR code and get access to some of the ecosystem report that I mentioned. That's it. Cool. I think we have time for maybe 5-10 minutes of questions. Happy to take those and then see from there.
Great talk, by the way. Yeah, thank you very much. You wanted to list 500 assets and many, many more eventually as time move forward. So is it harder to find new assets to list or market makers to actually trade on those?
So the question is it harder to add new markets or get liquidity in market makers for those assets? It's very much a chicken and the egg problem. I think right now, if you look at the volumes on the exchange, like Bitcoin, Ethereum really are the bulk of the volume, but the balance of the 48 other markets that we provide account for 30-40%. And it's hard to kind of predict what people want to trade. One week it's meme coins, the other week it's AI coins. And so really getting to a place where we can list more markets faster is really kind of the objective in the short term. I think the lowest hanging fruit there is the top 100 coins by market cap. That seems fairly straightforward. Then getting into the longer tail of assets, anything that is traded on Uniswap, anything that's traded on Osmosis, on various DeFi oracles, that seems like kind of the next set of assets to list. Again, I think you need isolated margining to really be able to support that from a risk management standpoint. But I think that expands kind of the listable universe to maybe 1,000, 2,000 tokens pretty quickly. And then, on your second question, once there's demand for those assets and it's validated, how do you actually get enough liquidity on the books? I think especially with an order book-based model, we've seen a lot of the leading market makers in crypto. If they're trading in DeFi, they're trading on dYdX. It's pretty, from the API standpoint, pretty easy to integrate and similar to like a centralized exchange standpoint. Getting liquidity for these esoteric long tail assets may become challenging. And so that's really where we think vaults can play a role around bootstrapping liquidity. And so ultimately you need both the demand side and the supply side of the market to have a healthy kind of balance.
Hi, I'm Emily from Chain Security. Really interested in listing these new assets and having this being governance-led, community-led. I wonder kind of what are the security implications of that? Because for example, with Compound, we've seen that sometimes there were some security risks introduced by having these proposals coming from the community, right? So I wonder how you're going to manage that.
Yeah, so the question is around how do you manage the security risks of having governance control which assets get added to the protocol? So when adding a new market to the protocol, there's various risk parameters that have to be configured. Things like margin requirements, things like equity tiers. All of those are parameters that can be changed by governance. Ultimately, we've seen kind of various community members, notably Chaos Labs, which is a large reputable kind of risk management provider, really participate in our forums and provide recommendations to the community on what they think are safe kind of risk parameters for any new governance proposals. And so right now it is community driven, both on the listing side and then on the risk management side. Ultimately, if a market becomes too risky, you could see a world where governance mobilizes itself to change a risk parameter, potentially reduce the amount of margin available. At the core of it is you do need an active community of risk managers to look at kind of the data and make recommendations. I think one thing compared to Ethereum and some of the challenges around mobilizing governance in Ethereum where it's one token, one vote. What's really cool about governance in kind of Cosmos land and dYdX chain in particular is validators basically inherit the voting rights of stakers, but stakers can override a validator's vote. And so by default, that just results in basically 60 validators, part of the active set, that are pretty strongly incentivized to participate in governance. So I think on Ethereum we had probably high single-digit voter turnout on a given vote. And that probably required, honestly, like a lot of mobilization to get people to care. In 2.5 years, we had probably, 35 governance votes, so really slow kind of governance process. In just 3 months on the dYdX chain, we've already had 30 governance votes, and each vote has about 70-80% voter turnout because validators are incentivized to vote because they run the software, they're very familiar with kind of the design. And so, the risks are different. You do need kind of a mobilized and educated kind of community to discuss the risks, but the community is able to respond much faster, which so far has been really great.
Hello, one of your V4 users, but I was curious, are the long tail assets markets going to be backed with the insurance fund?
So the question is, are the long tail assets going to be backed by the insurance fund? It's a very good question. My assumption is yes, though don't quote me on that quite yet. Again, there's going to be differences in how isolated markets are treated from cross-margin markets. I'm not sure whether there's going to be a separate insurance fund just for isolated markets or not. But the theory is that the amount of leverage will be less than what you would get in kind of cross-margining, and you'll have to use either a sub-account or kind of an individually funded account to trade those markets. But the actual risk management and liquidation engine for kind of the long tail. I think those designs are still being kind of finalized, but my assumption is, the goal is really to segment risk, and so not impacting kind of the solvency or the insurance fund of the cross-margined assets as well.
Yeah, that makes sense. I guess, like, what do you think of the trade-off of, so as you said, right, liquidation is going to be probably pretty important, to avoid bad debt, and you guys are on an app chain, so for market makers, they need to like liquidate, or people providing liquidity to liquidate those assets. They're probably going to need to do it on other chains like Uniswap, Mainnet, et cetera, et cetera. What do you think of the fact that you guys are isolated from those markets?
Yeah, so again, I think the designs around how these isolated markets are going to be kind of ingested into dYdX chain, I think will be shared shortly, so I won't share too much, but I think one of the benefits of having an app chain that is Cosmos enabled is that you do have interoperability by default with all the other Cosmos chains out there. So, Osmosis being kind of the largest AMM for spot in kind of Cosmos land does create unique types of interoperability and composability that could help kind of on the hedging side. Granted, not all assets on Osmosis are on Uniswap and vice versa, and so ultimately, we'll have to get back to you on some of the implementations on the liquidation side, but the goal is, how do you really increase the number of new markets is really the driving objective for the next few months, but then how do you do that in a way that you don't compromise risk or solvency? I think we'll be able to understand a lot more of that once the designs for isolated markets and margin is released publicly.
Hi, Michael from Astrobit. So we've seen in the graph that dYdX has started to dwindle in market share this past year, and that's partly due to Web3 users farming for airdrops and more malicious things such as wash trading. So from a BD and strategy perspective, what initiatives are you taking to recapture our current users trading on other exchanges?
It's a great question. I think it's been interesting. I've been within kind of the dYdX family for the last 4 years, and every year there's kind of a new set of competitors that come up. And I think for the first time in 4 years, we see real competition on the DEX side that we take more seriously than competitors in the past. Granted, there's a lot of wash trading. There's a lot of unsustainable incentives that is driving a lot of that activity, which I think is fine and to be expected, and it drives innovation and it holds us, puts the fire under our feet a little. I think the thing we think about from a strategy standpoint is how do we really win over the next 5 to 10 years? What market share looks like in the next quarter can be highly skewed, but how do we really make decisions that improve product market fit, really focusing on organic demand and not trying to drive inorganic activity. So from a strategy standpoint, it's really being long-term focused is kind of the biggest kind of framing that we use. The second is, again, we've been focused on the infra level for the last 2 years. The product on the app side really hasn't changed very much at all, and yet we were able to maintain dominant market share, really getting to improving the product experience, improving the UI, UX, supporting key partnerships, really getting to product parity with centralized exchanges from a look and feel standpoint is what we're focused on in the short term. And then lastly, it's really focusing on these 10x growth opportunities. So new market listings is a way to expand the number of markets, attract new traders, attract new users. That'll help kind of drive some volume and growth. But the 10x growth opportunity here is clearly permissionless markets, and really allowing that type of permissionless innovation to flourish is something that we're focused on.
Is there any MEV issues with the validators, and how do you monitor that?
Yeah, so the question is are there any MEV issues with validators, and how do you monitor that? So today, MEV happens on Ethereum. It happens on a lot of different chains. An app chain is no different. One interesting way that MEV has been mitigated so far is really by raising kind of the community's awareness of what is MEV, and then getting to a definition of what does MEV look like on dYdX. So there's been a lot of blog posts, both from dYdX trading and then also from the community, on how to measure MEV. And then Skip Protocol actually launched an MEV dashboard that publicly tracks order book discrepancy for each validator on a time series to track the likelihood of a validator doing MEV. To date, there's really only been one validator that has potentially done some MEV, but that's been kind of actively discussed within our forums, and the approach so far has been around social mitigation, so public shaming and ultimately social slashing, which can be quite controversial, but has been an effective deterrent so far. I think Antonio, the founder of dYdX, has taken a very public stance around being very anti kind of MEV. Ultimately, it hurts the retail trader, it hurts the end user, and that's something that we know is an important factor, and that we should continue to think through how to mitigate that. In the short term, it is very addressed by kind of the social layer, and as we get kind of more data in the long run, figuring out a way to continue to disincentivize MEV at the protocol level is an activity, like an area of active research across the board.
Yeah, I'm one of the kind of algo traders on dYdX. I was curious if you know any metrics on the percentage of algorithm volumes versus like retail volumes.
Yeah, so I think the question is, what is the percentage of volumes from professionals versus institutions, or institutions versus retail? Yeah, so I think, like for any exchange, right, you need both maker volume and taker volume. As a perpetual DEX, we're very focused on two user segments, like the institutional user segment, that's market makers, it's pro trader, it's hedge funds, it's prop capital, it's API traders, and then we're focused on pro retail traders. We're not focused on the long tail of retail. Your first-time crypto buyer, or your person who's buying spot, again, trading on a perp DEX, the user journey, you need to buy USDC, you need to move that to a self-custodial wallet, you have to know how to trade perps. It's a pretty complicated product. I think if you look at volume, I would estimate probably 70-ish% comes from market makers, and maybe 30% comes from retail. But the chain is still only 3 months old, and so those stats may change over time. My expectation is, if you look at Binance, or you look at even FTX back in the day, retail interest drives market maker interest, and liquidity begets liquidity, so you need kind of both sides of the market. I think right now we probably do a better job on the market maker side, and a big focus for us is how do we really grow the pro retail side of the market. Yeah, so the question is, how do you bootstrap liquidity for new markets? Today, there's really no kind of additional incentives for bootstrapping liquidity. Like there's, a bunch of market makers who are already on the platform that every time a new market is listed, have been contributing kind of liquidity to the order books. So in the short term, we're very just focused on how do we bring on more market makers so that they can compete on providing kind of liquidity. What's been interesting is because these new markets are added via governance, in some cases it's actually even market makers that are putting together the proposals to add these new markets to the exchange. So, Wintermute has been quite public, but they've put together several governance proposals for several markets. So presumably they're pretty ready to quote as soon as the market is available. So that's kind of their strategy in the short term is just get more market makers activated and list markets that people want to trade. Once again, you get into the longer tail of markets and things that are more esoteric, that's where the vault strategy that I described is really our current thinking on how do you bootstrap a new market in the very early days and then incentivize market makers to provide liquidity on top of that. Beyond that, there are two types of incentives on the exchange today. There's kind of a trading reward incentive that is more focused on kind of the taker side of the exchange. And then there's a 6-month incentive program that Chaos Labs has been spearheading that rewards both maker and taker volume, including kind of liquidity provision. And then lastly, there is the 30-day maker-taker fee schedule where there's a maker rebate that also incentivizes market makers to quote in the books.
I'll do the last question to wrap it up. Thank you so much for this presentation. And I'm just curious, because we keep talking about how to 10x and 100x DeFi derivatives volume. So to get in more markets, I'm curious how you're thinking about pre-launch markets and potentially launching markets before tokens have listed.
Yeah, so the question is, how do I feel about pre-launch markets and whether I think that's kind of a long-term direction for dYdX. I think pre-launch tokens are definitely something super interesting. Like you see, I think FTX started to do that, and then there's a few other DeFi DEX, perpetual DEXs that are focused on pre-launch markets. It's definitely a different type of market relative to something that is already listed and liquid. I think we're exploring how to support that. I think you end up with unique challenges on the Oracle side in particular, but it's something that we're actively exploring. And ultimately, if there's really strong demand for pre-launch tokens, we want to be able to enter and address that need. But I think actually if you look at volumes for pre-launch tokens relative to what is already actually listed, the demand isn't like that massive, and it's kind of temporal, right? You kind of see it in the run-up to a potential airdrop, but then it trails off pretty quickly, or it's temporary in nature. So it's an area we're actively kind of tracking, but right now we're really more focused on listing the long tail, and then if there is significant demand for it, it's an area that we can always add in the future. Cool. Well, thanks so much, everyone, for coming by. I'll stick around, and feel free to come by if you have any questions.